In this video, we will look at which option to trade by comparing different categories of options. We can think of options in three main ways: in the money, at the money, and out of the money. When you buy an in the money option, you are paying for existing value, which we call intrinsic value, along with some time value, which makes the premium high. On the other hand, at the money and out of the money options have no intrinsic value and are made up of 100% time value, meaning their prices are purely based on speculation about future price moves. Moving on, we need to understand the uncertainty level and how it affects pricing. At the money options have the highest uncertainty because even a very small move in the market price can change their status to either in the money or out of the money. This high level of uncertainty is fully priced into the time value of the option. In contrast, in the money and out of the money options are more stable because minor price changes do not usually change how they are classified. Now, let's explore a call option buyer scenario where you have a bullish outlook and the current index is at 25,562. If you look at a deep in the money strike price of 25,300, the premium you pay is 327. We can calculate the intrinsic value by taking the index of 25,562 and subtracting the strike price of 25,300, which equals 262. As the strike price goes higher, like 25,600, the option becomes out of the money and the premium is purely time value, representing a higher risk. To understand your potential outcomes, we look at the profit and loss matrix at the time of expiry. Your break-even point is calculated by taking the strike price and adding the premium cost. For example, a 25,300 strike plus a 327 premium equals a break-even point of 25,627. If the index stays at 25,300, you would lose your entire premium of 327. But if the index rises to 26,000, you could see a profit of plus 373. It is important to remember that your maximum loss is always capped at the premium you paid. We can also perform a profitability analysis using return on investment or ROI. If the index rises to 25,800, we calculate the ROI percentage by taking your net profit, dividing it by the premium paid and multiplying by 100. In this specific case, the strike price of 25,500 is the winner because it provides the highest return of 62%. While the deeper in the money options are safer, they often provide a lower percentage return compared to those closer to the current market price. Now, let's look at the seller's perspective for call options, where the outlook is typically neutral to bearish. As a seller, your maximum gain is fixed at the amount of premium you received from the buyer. However, your risk is unlimited as the index rises because you are betting the market will stay below a certain point. For instance, if the market moves against you and rises to 26,000, a seller of the 25,300 strike would face a net loss of minus 373. Next, we look at a put option buyer scenario, which is a strategy used when you have a bearish outlook and are betting on a price fall. With the index at 25,562, a strike price of 25,600 is considered in the money. We calculate the intrinsic value for a put by taking the strike price of 25,600 and subtracting the index of 25,562, which equals 38. Strike prices like 25,300 are cheaper because they are out of the money and consist of 100% time value. Looking at the put option profit and loss matrix, we can see how different strikes perform if the market crashes to 25,000. For a 25,300 strike, your profit would be plus 235, while the 25,600 strike would yield a profit of plus 433. Your break-even points are also critical. For the strike of 25,600, the break-even point is 25,433. In the event of a drastic market fall where the index drops to 25,000, we see a very high return on investment for put buyers. Deep out of the money puts yield the highest percentage return because they were the cheapest to buy initially. For example, the strike price of 25,300 yields a massive return of 362%, showing how powerful these options can be during a market crash. Now, let's consider the seller of put options, who generally has a neutral or bullish outlook. The seller's main risk is a significant market fall. If the market remains stable above 25,600, the seller of that strike earns a gain of plus 167. However, if the market crashes to 25,000, that same seller would face a large loss of minus 433. Sellers of in-the-money puts collect more premium but face losses much sooner if the market starts to drop. We can compare these put selling strategies by looking at the risk versus reward. Selling deep in the money puts at 25,600 is an aggressive income strategy that offers a high reward of plus 167 but carries high risk because the market is already close to the loss zone. Selling deep out of the money puts at 25,300 is a more conservative strategy, offering a lower reward of plus 65 but carrying lower risk since the market must fall significantly to trigger a loss. Finally, we have the trader's toolkit for strategic synthesis. Success in trading lies in matching the right instrument to your specific view of the market. First, you must perform a market analysis to assess volatility and direction. Second, you need to determine your risk appetite and how much loss you can tolerate. Third, you execute your plan by selecting the right instrument and the most appropriate level of moneyness, whether it is in the money or out of the money.